Welcome to Mortgage Markets and More. I'm your host, Peter Dangelo. Long time no talk. I know we just had our update yesterday with the National Association of Realtors existing home sales data. I hope that you found that helpful and useful. I will be reporting out next month when the next report is out for October. But today we're going to talk about the mortgage rate environment, and the roller coaster ride continues. Let's just start there. It's been very difficult to manage expectations properly because things have been all over the place. We were riding really high with the Fed announcing a 0.5% cut, thinking great, inflation's moving downward. There was some weakness in the job market, paving the way for us to maybe have this soft landing. Well, let's fast forward not even more than a week to 2 weeks, and rates started coming up. And last week we talked about some of the why, and that has promulgated forth as we've continued forward since last week, with rates continuing to climb from last week's review. We did have a little bit of a mixed bag. Now it is across the board increases. So without further ado, let's talk about where interest rates are right now. The 30-year fixed rate is averaging, according to Mortgage News Daily, 6.92%, and that's up from 6.63%. So we're tickling 7%. This is an average we're talking about, so good and bad credit profiles, people paying discount points for a premium up front to get a lower interest rate, all considered in this. Most are possibly in the sevens right now. So that's where we're at with the 30-year fixed rate mortgage. The 15-year fixed rate mortgage is at 6.38%, and that's up from 6.07%. The 30-year jumbo's at 7%, and that's up from 6.74%. The 30-year FHA is averaging 6.38%, up from 6.1%. And the 7.6 SOFR adjustable rate mortgage is at 6.78%, up from 6.53%. We've seen it go up across the board. You may have noticed it's a little different than prior episodes. I wanted to talk about the interest rates first because the bond market and the why behind this interest rate environment should all probably be put together. So I thought it makes more sense for us to now talk about the bond market to explain why this rate environment is what we have right now. 10-year treasury, that yield is at 4.192%, and that's up from 4.016% last week when we reported out. But it's important to note that it topped out at 4.25%. That's an important number because we look at the average of what this 10-year bond yield was looking like and the trend, and it started moving above a trend, what we call a trend line. So we're seeing that, well, we peaked at 4.25% this week, and it's backed off. As of recording this episode the Thursday morning before release, the 10-year bond has actually backed off a little bit even further from what I'm reporting. So when you listen to this, it may be lower, but it just goes to show that there's still a significant amount of volatility. The 5-year treasury yields at 4.005%, and that's up from 3.844%, but that also peaked around 4.061%. The 2-year treasury is at 4.094%, and that's up from 3.94% last week, and it also peaked at 4.087% this past week. All of this is what's setting the stage for the current lending environment and the current interest rates. And here's some of the reasons why. First, the things we discussed last week are still having an effect. The data that we talked about, to refresh your memory, we're talking about the initial jobless claims from the October 5th report, then the CPI, Consumer Price Index, which is an inflation reading, and the Producer Price Index, which is a reading that kind of gives us an indication of where inflation could be going. That all that information was continuing to be digested as we also heard, and this is another factor, the Fed members. As I've mentioned before, the Federal Reserve is comprised of 19 different Federal Reserve Board members, and they have all been making their own comments about monetary policy and what their perspectives are. It's their consensus that really creates the monetary policy that rolls up to Fed Chair Jerome Powell when they make their decision, and he's the figurehead that presents this, right? Well, there's dissent among the group. It's not a unified message that we're hearing from all Fed members. Some believe that staying data dependent means that we're also going to have to maybe cool it with the rate cuts until we see things stabilize a little bit. Some Fed members believe that rate cuts are still appropriate to stay ahead, to make sure that we don't have interest rate environment that is going to constrain growth and possibly lead to unemployment ticking up further and inflation maybe going too far low, which I don't think that that's really part of the conversation right now, but it remains to be seen that we need to keep our eye on the ball with this data, but also keep an ear out for what the Fed members are saying, because that's essentially what's going to dictate the monetary policy. And as we've learned, it's the monetary policy that's driving so much of this right now. Some other things that have affected mortgage rates and the overall lending environment after last week's episode release were a couple pieces of data. One is retail sales. So that went up 0.4%. There was a forecast of an increase of retail sales, 0.3%. And so it's slightly higher than that. And compared to the month prior, it was 0.1% growth upward. This makes sense. We're in an interesting time right now because Thanksgiving this year falls very late in the calendar, very late in the month of November, which is creating an abridged holiday shopping season. What that's doing for us by way of things like the retail sales numbers, we're seeing quite a bit more shopping happening early because there's not going to be that much like Black Friday time, Cyber Monday, and then, Cyber Monday's happening in December this year. That's crazy. So there's a number of different retailers that are gearing their sales earlier to try and capture just more sales over a longer period of time instead of that big holiday rush. So that is likely what we're seeing a little bit of in those retail sales numbers. But strong retail sales means consumers are spending. When consumers spend, it supports inflation and what the prices are. Now, if the prices go down, inflation won't be that much of a concern, but there's a lot of money that people are spending. And money spent, inflation, it all comes together. Also, we got our initial jobless claims for October 12th. They were at 241,000 initial jobless claims. The expectation there was 260,000. So that's quite a bit lower than where the expectation was. And so lower numbers on initial jobless claims equals stronger job market. Less of a case for the Fed to cut rates if the job market's staying pretty stable. Also, I don't want to get too far into the weeds with this, but the last thing I want to mention to illustrate the why behind the rates that we're seeing is really tied to the bond market. So to kind of circle back, bonds are issued at auctions, and then they can also be sold after auctions. So if you're holding a bond, you can sell it. But the bond auctions are really where we're getting our prices for the bonds, and price of the bond, fixed amount that you'll get at the end of your term. So if the price goes down because there's increased supply, let's say, and or lower demand, well, then the yield is going to be bigger because you're still getting paid the same amount at the end of that bond term, but the price you're paying for it may be lower. If that's the case, that's why we see these yields go up. We focus on the yields because that's what sets the stage for the rates, not just mortgage rates, but any type of lending rate. With all that being said, this increased supply of bonds is creating a situation where the price that the investors are paying for the bonds is now lower, and that's creating a higher yield. The federal government has a lot of debt that they need serviced. They get their debt serviced by selling bonds because that's the way that they get capital for the debt that they have. There was one bond auction for the 10-year treasury bond, which is very closely tied to mortgage rates, and it was a lackluster performance. There was not that much interest. A lot of that, and I talked about this in yesterday's episode, but it also could be a situation where people are in a holding pattern, even with making decisions with their finances in the stock market, in the bond market, because of, I know, you're probably tired of hearing it, the election. The election has a lot of people just waiting in the wings to see what's going to happen and then make decisions. So this could be just how it's going to be until November, until we have the election. And then I think it's going to be very important for us to take a look at what do things look like after the election, who's elected, and how the market reacts. There's always some sort of market reaction, but the market reaction is, again, going back to the concept from yesterday of the behavioral economics of it and the psychological component, because tangibly, nothing is really changing. It's people's thoughts, expectations. I think we can agree now at this point that we have seen through all of these episodes this year that we've talked about mortgage rates and about the markets, expectation is what drives so very much of what's happening, not actually what's happening. So we'll keep an eye on these things, and I'll keep you posted. Before I get to the Did You Know section today, I wanted to highlight something that I thought was interesting. I was doing some research, and there seems to be a little bit of a shift in mentality when it comes to buying versus renting. This has been something that's been a topic of conversation since interest rates have gone up so much, because buying became more cost prohibitive compared to what rents were, even as rents were rising. And this is speaking to particular markets. There are still some markets that make sense to buy, and things that will really affect whether it makes sense in the metrics and in the numbers is how much down payment you have and what your monthly payment would look like. But I wanted to highlight a couple things. So one concept is that renting has somewhat become like a lifestyle choice. So people who are proponents of renting, they like the flexibility because it's leases and then they can go. And then there's some sort of financial predictability to it, albeit you will get rent increases with time. But the other things that you save money on are things like, well, if you own a home, if something goes wrong, you have to fix it. If you're renting, that's not on you. It's on the landlord. So there's been a little bit of a lifestyle choice. Then there's also the concept of, kind of homeownership as a goal, and that aligning a lot of people to still be highly motivated to purchase a home. We talked earlier this year about a record of average American wealth. So the average American and their net worth reached a peak a few months ago, I think probably about 6-7 months ago, and I reported it out on it. The reason for that was because of home value appreciation. People who buy homes gain a lot of equity over time beyond them paying down their mortgage and gaining equity, but also appreciation in the market. So home ownership as kind of a financial goal is supported by property appreciation where you get more equity. And then there's tax advantages. So if you have mortgage interest, there's a prescribed amount that you can write off every year, and that helps from a tax standpoint. There are some other financial realities of renting versus owning that seem to be in consideration. Equity versus flexibility, it's really a personal decision based upon what you value more. Do you value the flexibility more, or do you value long-term wealth, long-term equity generation in your home? And then the total cost of ownership. So down payment, closing costs, what your interest rate is, what the carrying cost is, anything that would be required to update the property as time goes on. Good rule of thumb is, every 4 to 6 years, you should be updating something in your property just to keep it relevant so that if you did have to sell, you're not suffering a large amount of money that you need to dump into the property at that time. There are also regional risks, looking at different parts of the country, renting versus owning. There's, market-dependent choices. So high-cost areas like California, the New York metro area could make it cost prohibitive. And then there's also regional things to consider like insurance. We're seeing that tangibly right now in Florida. If we think back to yesterday's episode about the National Association of Realtors, existing home sales data, and what's been going on in Florida, home prices have been going down there, and in large part due to an increase in insurance premiums, which if you're purchasing a home with a mortgage, you need to have homeowners insurance. And if you need to get homeowners insurance, you're subject to whatever the rates are for those insurance policies. And the more policies that need to be paid out because of claims due to hurricanes and severe weather, the higher the premiums go to fund those claims. So that's something to keep in mind. Now, for the Did You Know section, I am very excited. I got to give a shout out to one of my clients who was texting me. It was one of my best clients and happens to come through a very close family friend, and very interested in the mortgage process. He's sought every piece of education, and we were talking about interest rates. And I was like, you know what? This would be a really cool thing to talk about, because we talk a lot about mortgage rates with respect to the lending environment, what creates it, and everything like that. But let's talk about interest rates and how they are priced for you. So I'm going to give you the Cliff Notes version, because this can get very convoluted. But let's start. Interest rates are what we call risk-based priced. That means the reason why you and your neighbor may get two different interest rates applying to the same lender. Let's say that you both apply to me and I have the interest rates for each of you. One may be different than the other, and you may wonder why. Well, that's because it's risk-based priced. I'm not even going to talk about different loan programs that have their implications for interest rates. We go through 5 different average rates every week. And so obviously you see that there's a difference by way of the term, but there's also differences in programs within a 30-year fixed rate mortgage. Let's just put that aside and let's talk about what risk-based pricing means. Risk-based pricing, it's a bit of a tongue twister, means that what your qualification factors are impact what interest rate you're going to get. So let's talk about what those factors are. Your credit score, depending on where your credit score is, will influence what your interest rate is. Secondly, what your debt to income ratio is. So when you're getting pre-approved, one of the key components of your qualification is taking into account what your gross monthly income is before taxes and compare that to the proposed debt of the property that you're interested in purchasing or refinancing, and all of the debts that are appearing on your credit. So that ratio will affect your interest rate. So that's number 2. The other element is your equity. How much down payment are you putting? That will affect your interest rate. There's also an interesting thing that happens, and it sometimes isn't the case and sometimes is, but sometimes putting 15% down on a purchase could get you a better interest rate than putting 20% down. If I can read your mind right now, I think I know where you're going with this. Wait a minute, I'm putting more money down. That's more equity, I have more skin in the game. Why would my rate be higher? It wouldn't be higher by much, if it is. But the reason for that is the fact that when you put 15% down, you're required to carry mortgage insurance. Mortgage insurance is required if you put less than 20% down. I'm speaking generally. That mortgage insurance policy does not protect you. It protects the lender in the event you default on your mortgage. So that removes a layer of risk. And so when you get an interest rate for 15% down, it may be a little bit better than 20% down, because 20% down is the line of demarcation. The one part that you can put 20% down and not have mortgage insurance now, but that's the minimum, right? So from the risk assessment standpoint, you're seeing, oh, well, that's the absolute least amount you could put down to not have the mortgage insurance, which is providing the lender with additional benefit and security. Well, now the interest rate goes up a little bit. So to highlight again, we have credit score, debt to income ratio, and your down payment. These are the 3 main components that actually create whatever it is that your interest rate is. That's risk-based pricing in a nutshell. It can get more convoluted from there, but I want to leave it at that just so that you know. And if you do have any questions, let me know. And you know who you are if you're listening. Thank you so much for inspiring me to bring this about and share with everybody this interesting piece of knowledge about interest rates and how they relate to you and your scenario. That's it for the show today. I hope you found this helpful, useful, and I wish you the best of luck. If you have any questions, feel free to reach out. You can email me at peter.dangelo@rate.com. Happy to answer any questions you have. I would love your feedback. If there's anything that you want to hear about on the show that I can talk about, maybe that would be helpful for you or people that you know, I would love to. So please reach out. Let me know if there's anything I can cover. I will be back next week for our regularly scheduled programming. Until then, we're getting some beautiful weather here in the Northeast. Wherever you are, I hope the weather's nice, and I hope you have a wonderful weekend, and take good care.